stop what you're doing. Seriously, if you have a single dime in regional banking stocks right now, you need to see this. I know this sector has caused a ton of heartburn for everyday investors lately, but last week I dove deep into the Q1 2026 data for a brand new stock, Beacon Financial. And honestly, what I found under the hood of this massive $22 billion giant is wild. Welcome to The Explainer. By the end of this, you're going to know exactly if this post-merger stock is a massive hidden opportunity or a complete value trap. Let's get right into it.
So Wall Street is currently agonizing over a literal billion-dollar question. When you take two massive regional banks and smash them together, do you instantly get a profit-printing machine or just a messy headache of growing pains? Well, today, we are stripping away all the hype and strictly following the numbers to find out.
Here is our roadmap for today's deep dive. 1. The birth of Beacon. 2. The Q1 2026 earnings breakdown. 3. The balance sheet reality. 4. Credit quality and risks. And 5. Wall Street's forecast.
Let's kick things off with Section 1, the birth of Beacon, and how they forged this $22 billion regional powerhouse. Let's rewind a bit to September 1st, 2025. Brookline Bancorp and Berkshire Hills Bancorp finalized this massive merger of equals. They completely dropped their legacy names and rebranded as Beacon Financial. Boom! Practically overnight, this created an absolute juggernaut in the regional banking space, boasting over 145 branches spread all across New England and New York. Now, while the legal paperwork was signed in September 2025, actually blending the operations of two giants is a lot like trying to combine two massive, complicated puzzles. It takes time. It all culminated in February 2026 with a massive core systems conversion, officially linking up their tech and day-to-day operations. Keep this timeline in the back of your mind because it is absolutely crucial for understanding their Q1 numbers.
Moving on to Section 2. Let's break down the Q1 2026 earnings and separate their true core performance from all that messy merger noise.
Here is where you really have to read between the lines. If you just glance at standard GAAP accounting, Beacon posted earnings per share of 55 cents. Sounds okay, right? But wait, when you look at the operating EPS, which strips out roughly $13 million in lingering one-time merger and restructuring costs, that number actually jumps up to 70 cents per share. And despite all those near-term accounting headaches, paying for that massive February systems integration, they still posted a super solid $46.2 million in GAAP net income. To put that into perspective, they only reported $19.1 million in the same quarter last year. Now, obviously, that huge jump largely reflects the fact that the company is basically twice its original size now, but it's still a big, impressive number. And frankly, management saw this coming. As CEO Paul Perrault points out right here in the earnings release, they totally expected these near-term pressures from the tail end of the merger activity. Now their focus is squarely on capturing the full financial synergies for the rest of the year. The heavy lifting, it's essentially done.
All right, Section 3. Let's check on the balance sheet reality by tracking their margins and deposits.
Real quick, before we start throwing numbers around, let's make sure we're on the same page about net interest margin, or NIM. It's basically the heartbeat of a bank's profitability. It's literally just the difference between the interest income the bank makes on loans and the interest it has to pay out to you and me for holding our deposits.
For Q1, Beacon reported a net interest margin of 3.78%. That's a tiny, modest 4 basis point drop from the 3.82% we saw last quarter. If you dig into the filing, they note this was mostly driven by lower yields on their loans and leases, though thankfully it was partially offset by some lower funding costs on their end.
Now, on the liability side, things get interesting. We actually saw a $1.2 billion drop in total deposits, bringing them down to $18.3 billion. But don't panic, context is everything here. This drop was heavily tied to normal, seasonal, first-quarter stuff, like clients making big tax payments or corporate payroll fluctuations. They also saw a little shifting around in higher-cost, rate-sensitive accounts. But the biggest takeaway? Their core consumer deposits, that sticky, relationship-based money, remained completely stable.
Okay, Section 4. We have to talk about credit quality and the risks, specifically those notorious commercial real estate headwinds.
You always have to watch out for the bad loans, and there is a definite quarter-over-quarter uptick in non-performing assets here. We're looking at a jump from $116.7 million at the end of 2025 up to $151.2 million by the end of Q1 2026. That bumps the ratio of non-performing assets to total assets up to 0.68%.
So what's exactly driving that nasty increase?
Well, their 10Q filing points the finger at two very specific commercial real estate culprits. First, a $17.5 million office property right in Boston, and second, $8.9 million tied up in a couple of rent-controlled multifamily properties in New York City.
On top of that, the bank actually had to eat $13.6 million in net charge-offs this quarter. That's up from $9 million the quarter before. Actually, this was mostly driven by the final resolution of a few specific big headaches: a large Boston office loan, a big equipment financing loan, and some smaller SBA loans. It's a pretty harsh reminder that the commercial real estate pressures facing the broader regional banking sector are very, very real right now. Finally, Section 5, Wall Street's forecast. Let's see what the analysts have to say about all of this.
When you look at the 6 analysts polled by S&P Global, the general consensus rating is a hold. They've pinned an average one-year price target at $32.67. Compared to the stock's trading price at the time of the report, that represents a pretty solid 12% upside. And hey, the most optimistic analyst out there is modeling a jump all the way up to $38 a share. And while you're waiting for that stock price to climb, Beacon is aggressively rewarding the investors who stick around to see this post-merger integration through. They've authorized a very healthy dividend of over 32 cents a share, which works out to roughly a 4.3% yield. And, this is absolutely huge, the board just pulled the trigger on a brand new $50 million stock buyback program.
So, that leaves us with one final crucial question. You've got a newly merged $22 billion powerhouse that just got through a messy, expensive systems conversion. Sure, they're yielding strong dividends and buying back stock like crazy, but they are also navigating some very clear, very real commercial real estate headwinds in the Northeast. Weighing those risks against the rewards, is Beacon Financial's post-merger potential enough for you to buy in? Let that sink in, and we'll catch you in the next explainer.